Welcome, everybody, to the Winning Momentum Podcast, episode 219. Today, we're going to address some listener questions, and you are going to learn later in this episode that this is my second tape of this entire show. I knocked it out of the park on the first run through of this particular episode, except my math was entirely wrong. Not my math, the Chat GPT math. And I'd be angry if it wasn't so funny and bizarre. I'll talk to you about that in a minute. So today we're going to talk about some listener questions. And for context, the questions were about last week's episode and some of the shorts that followed that, where I talked about attracting strategic investors, not just financial investors. And so just give you a little context on that. If you are selling your business or if you're trying to raise money for your business, you broadly speaking have two categories of investors or acquirers. Those broad categories are one, financial, and two, strategic. What is a financial investor or financial purchaser? Well, a financial investor would be any institution or individual that's in it to invest as an investment, to invest some money into your business, get a return, get their money back, make some interest, make some yield, make some dividend, make a capital gain, whatever it is. A bank, a private equity fund, venture capital firm, family office, angel investors, high net worth individuals. These would all be examples of financial investors. Strategic investors. Well, strategic investor is any investor that may have some related synergy, something on top of the financial merits of that investment. We talked last week about 1 + 1 = 3 is a synergy. So one question that was put forward to me a bunch of times from different individuals on different platforms was, hey, that sounds really cool, Scott. We should think about strategic investors when we think about raising money, not just financial investors. How might we find one of these strategic investors? So we're going to answer that in more detail today. First thing you need to think about is, what is a strategic investor? I talked about an investor that stands to benefit, or they believe they stand to benefit from a synergy, something beyond the financial merits of the investment. Well, who might have that sort of belief? Think about vertical partners when you're thinking about trying to go find a strategic investor. A vertical partner might be a good place to start thinking about that. What is a vertical partner? Well, you have your business and you have suppliers to your business, and then you take those supplied goods and you do something to them, and then you sell to your customers. So there's a supplier, your customer. Suppliers and customers are vertical partners that you could think about as being strategic investors. On the supply side, suppliers might want to lock into a key customer for the long term and to vertically integrate their business. And so that might be an excellent, suppliers are often a very good strategic investor, strategic acquirer choice, somewhere to first look to and start that discussion and see if there's any synergy to be gained. Many of you know that I am president of a company called Globex Extraction Services, and we just started a search. It's in the hemp processing industry, and we just started a search for strategic partners, not necessarily investment, not necessarily a sale, more of a merger in a roll-up program, which I'll talk about shortly, but same sort of partners. You're looking for the same sorts of companies when you're looking for a strategic partner. And we're looking for that. And we started those discussions. And it really seemed to me that an ideal candidate would be a customer of ours, or someone who could be a customer of ours, someone who had a brand, created products that were used directly for the consumers, and that could use our wholesale manufactured crude distillate isolate in the CBD hemp space. And so if we were to lock into a larger customer with some owned brands, that would help the manufacturing a lot, and it would create some synergy. So always look to your suppliers and look to your customers. Another example on the customer front is that I had purchased a few years ago. I won't go into any of the details and names on this because the party that helped us out is a public company, and I don't want to trample on their disclosures by any means. But we were trying to buy a company, and it was locked into a major customer, and we were having troubles closing the acquisition for, of all the stupid reasons in the world, because we were having troubles getting the insurance placed. And this company, our customer, was able to help us with that with their balance sheet for a short period of time, and it worked out great. We were able to go to this strategic investor, which was a customer of ours, and that was a great deal. And so, suppliers, when you think about strategic investors, first start thinking about vertical partners either on the supply side or on the customer side. Second, think about competitors, both indirect and direct competitors. Direct competitors, you say? Scott, come on, that's crazy. That would never happen. Do you remember Microsoft invested $150 million to bail out Apple in 1997, and failing that strategic investment, Apple would have gone bankrupt. They would not have survived. They would not have been the company that they are today. $150 million from Microsoft to a direct competitor. Why would they have done that? This does happen from time to time. Microsoft's reasons, beyond the financial, which were probably not a primary driver because they had plenty of money back then, the reasons were antitrust, right? If Apple went away, Microsoft becomes a real monopoly, and they felt they were going to be in trouble with the antitrust people in the US. Apple and Microsoft combined were doing a great job back then of growing the adoption of personal computers in the home, the workplace, etc. Thinking back now, like, it looks crazy. Obviously, everybody's going to have personal computing power, but in 1997, it was a relatively new thing. I remember I was being pitched PC deals all the time back then. From a venture capital perspective, we were doing deals, and every day there was a new PC company popping up, building PCs, and that was the hot new technology of the day. So Microsoft at the time believed that having Apple as an active competitor would expand the market overall, and they would be better off with Apple as a competitor than they would be without Apple as a competitor. And they also got some strategic concessions as part of this investment. Specifically, they started developing software, as I understand it, for the Apple platform. So there is an example of a strategic investment in a purely direct competitor. It does happen more often than you think. Not always. Not always. It's a rare thing. I admit that, but it does happen. Okay. Indirect competitors, these would be similar companies in other markets. Okay. So companies that, if they were in your market, would compete with you, but they're in a different jurisdiction. I, as many of you know, am president and owner. We are Sinclair Range's 100% owner of Equip Innovations, which is tier 1, tier 2 automotive parts manufacturer. And in particular, this company makes rubber sealing systems for cars and helicopters and other things along those lines. And it has to ship these things to foreign jurisdictions. And they're big, complicated, delicate pieces that take a lot of packaging, but the value of each unit is not very much. And so it's really stupid just to be shipping these things all over the world. Equip would benefit greatly from a strategic partner in other jurisdictions, in Europe, in Asia, similar companies that would be competitors of ours if they were sitting across the street. But because they're in a different jurisdiction, it makes a lot of sense for us to merge, for us to invest in each other, for us to do something so that we are a stronger, better solution for our customer base. And we're in those discussions right now, and we entertain those discussions all the time. So there's an example of an indirect competitor that provides a possibility of a strategic investment. Think about distribution channels. Always a key when you're searching for a strategic investor, something where the other company has a strong distribution channel, and you have a cool new IP or product that you can't sell but could sell greatly through that channel. I always talk about on this show about in the 1990s when we were doing VC deals like crazy. And this was the tech boom in Ottawa, Silicon Valley North, they called it. And you would have, it seemed every day, someone who was coding something in their basement, and it was the next world-beating piece of code, and just take for granted that it was amazing, but they couldn't sell it. They couldn't sell this code because they had no platform. They had no distribution. They had no, it's hard to just greenfield a distribution channel and to spend the marketing dollars. And just so often, you just saw it all the time. The code was worth nothing to the company that invented it. But if you gave that world beating piece of code to Microsoft, who was the operating system and who had other applications for most of the world at that point, and if they could bolt your solution onto their product and charge a little bit more for it, it could be worth billions or hundreds of millions, anyways, back then. So there's an example where something might not be worth anything to you because you don't have distribution, but a lot to somebody else because they do have distribution and maybe you have some interesting IP. And so that would be an example of a possible strategic partner, acquirer, or investor. I talked about roll-up programs before, which sort of comes back to competitors, direct and indirect. Roll-ups in a space, we're doing this in the hemp industry right now. Roll-ups is when you look at an industry and it seems small and fragmented and everybody's suffering, but you just think to yourself, wow, if I took companies A, B, company C, company D, company E, and I merged them all together, got rid of the redundant costs, and took 5 small companies and turned them into larger companies, into one larger company that was profitable because we got rid of the redundant overheads and fixed costs. That's what a roll-up is, okay? And that's effectively the business of private equity. They buy a platform, and then they look to add to that by acquiring other companies and merging them in, and then to exit and sell at some point. I'm looking at that, as we said, in the hemp and cannabis industry right now. I'm pitch deals regularly in hardware, in veterinary clinics is a big one. Health clinics is a big one right now. And so if you're thinking about finding a strategic investor, think to some extent about the opportunities for a roll-up. And that would, that's just another form of thinking about direct and indirect competitors, but it is a financial play that happens very often in industries and is useful to think about when you're looking for a strategic investor. So now that you know the categories of strategic investors, how might you go about finding one? Well, if you're in business and you've paid attention, you know who your suppliers are, you know who your customers are, you know who the players are in the other jurisdictions. You've met them at trade shows or what have you. You've shared notes, had a cup of coffee, as the saying goes, and those are your targets. Those are your targets. If you don't know them or you don't know enough of them, then you have to do a search. You have to do a search in the form of an M&A process, which is typically done not by yourself as the business, but you would hire someone like Sinclair Range, an M&A advisor, or some sort of intermediary to help you do this. And what would we do to help you find that strategic investor is we would first accumulate a database of targets. And a database of targets is, by the way, we spend a lot of money on this overly priced database with pretty much every public company in the world and lots of private companies on that database. And we could do a search by SIC code, so the industry that you're in, the details of the part of the industry that you're in. So SIC code, geography, we can screen it for revenue size, profit size, all those sorts of things. And we can come up with a database. And what it spits out for us is a database of the company name, any financial information we want, the officers, the description of the business, and that is our starting database. You can do that on Google. You can do it through trade associations. You used to get the journals back in the day, but you can go online, get membership lists, that sort of stuff. It's easy to accumulate the database, but it's a lot of legwork to accumulate the database, particularly if you don't own the database and you have to go Google it and find some other ways to get this information. But you do need a database because M&A is a numbers game. For me, typical industry, I'm looking to target 500 to 750 right off the bat in the database. And if you do that, by the time you get through the process, you're going to end up with NDAs signed by maybe 10 of them and a real discussion between 3 to 5 parties to do a deal. All right, that it's really a numbers game that works that way. And like I said, it's a lot of work, but it's pretty easy. What do you do with that database? You then send them a teaser letter. What is a teaser letter? It's a 1-page. Back in the day, we used to fax them. Now you email them. If you have the time, you follow up with phone calls, but you send out a teaser letter, not on your letterhead. You want to have an introduction to what you're trying to do. Hey, we know of a hemp processing facility with proprietary technology located in the US, does about 2 million in revenue. It's a private company, and we think that there's a roll-up opportunity in this space, and we're looking for strategic partners. Give us a call if you're interested, right? That's the form of a teaser letter in one page. And if they're interested in that sort of deal, then they can get back to you and they can sign a non-disclosure agreement and you can go forward with further discussions. If they're not interested, no harm, no foul. You didn't give the name of your company. It'd be hard for people to research it, figure it out for sure, call your employees, call your customers, screw up your business. You don't want to do that, right? So a teaser letter is salesy, yet generic, enticing, yet not giving away all of the information so that you don't get into trouble and damage your business. So you send out a teaser letter, people respond, sign a non-disclosure agreement, then you go into a discussions, into providing an information package or a deck of some sort, data room for due diligence. That is the M&A process. Well, it's the exact same process. If you came to me and said, Scott, here's my business, I'm looking for financing, I'm striking out with the VCs, I'm striking out with the banks, is there a way to get a strategic investor? We would go through that process. It is precisely the same. All right. So that is how you find a strategic investor for your business, an often overlooked category of investment. All right. Now, the next question we had are different category questions, mostly from one individual, related to investor valuations and so the societal benefits of investing and how and why financial investors don't really take the high risk on longer term projects. And this was largely, as I said, from one listener, and I'm not going to tell you who that was because I don't have their permission. It would be cool information, but I can't give it to you. And but I will read to you some of their points. And this person said that sophisticated investors are so obsessed with their formulas for getting 2% of their investment to be unicorns. That comes from, by the way, I think I was describing the VC business in the last episode, where if you have a portfolio of 10 companies, 2 are going to go bankrupt, 6 are going to bounce along and never do anything. And so you're not getting a return on 8 out of 10 of your investments. So you have to make up all of your profits in the 2 that actually succeed. And that has to be a large enough profit to make your whole portfolio worthwhile. Okay, but that's 20%, not 2%. The 2% refers to the idea that only 20% of the deals that you did actually pay off. How many deals did you not do? And I think the answer to that is going to be largely that you probably passed on 90 other deals before you even did the 10 deals. So in other words, you might be interested in 1 out of 10 deals that you see. For many VCs, it could be a much higher number. It might be 1 out of 100. But anyways, you get the general idea of this, which is, 2% of the investments are unicorns. And then he says that they're overlooking the long-term horizons of how bringing about societal value through innovation, one can also create a lot of opportunities and make money. He goes on to say that a great example of that would be SpaceX, which is now doing raises $130 billion plus valuations. Why don't we all try to find the next SpaceX, because it will help humanity and the money will come as a byproduct of helping humanity. And I think one of the reasons I would find it interesting to tell you this person's name is that they run a fund, it appears to me, that does exactly that type of investing, the longer term, deep tech, long horizon, high risk. And that's an unusual animal. And so applause to this person for doing that. Now, why don't typical investors and financial firms invest in these sorts of products? Well, number one is I want to talk, products that have societal benefit, for example. First, I want to talk about the definition of value from a financial point of view. Okay, and that's going to be the key to my reply to this. So, when you're a trader, of any asset, stock trader, but if you're a trader of any asset, real estate, there's a market value to the asset that you're buying or selling, right? There's a market value to that asset, and it's a spot value, right? At the time of the trade, not even the day of the trade, of the exact time of the trade, there's a value that can be determined that most people agree on if it's a real market, and that is market value, all right? But if you're doing investing, if you're looking at the long term, you can't rely on market value because market values can be up and down and all over the place. You have to rely on fair market value, which is more of a looking at the intrinsic value, the internal value of the company that you're investing in, and it's sort of averaged over time, if I can put it that way. So fair market value is a different definition of value, and the definition of fair market value is the highest price available in an open and unrestricted market between informed and prudent parties acting at arm's length under no compulsion to act, expressed in terms of money and money's worth. Okay, that is the definition of fair market value. Now, I know that many of you are younger than me and were trained in this area of valuation after I was, and you have a different definition, but it's the same definition. It's just different words, right? Maybe yours is a little more simplified. That's mine. That was drilled into me forever. Remember the last part of that definition, expressed in terms of money and money's worth. The whole definition of value boils down to a mathematical calculation of cash. That's what it is. That's what fair market value is. That's what value is. It does not include societal benefit. It does not include ESG. It doesn't include anything like that. Okay, that may be of tremendous value to society, but that's a different value. Okay, when you're investing, it's fair market value. It's about money, and it's about the math of that money. Societal benefit has value, obviously. You know, one thing that I think a lot about, I'm not sure what to do about it, but I think a lot about right now is the poor in the US, better education for those children would have huge societal value. What's the economic monetary value of that? I don't know. I haven't got that far in my thinking. What about political value? It clearly doesn't have enough political value. Otherwise, somebody would be doing something about it. Obviously, the politicians on both sides would rather have that as an issue than as a societal benefit, right? And so my only point is to say that there is many different types of values. And I think that when we start commingling that, when we start saying, yeah, what about the societal value and our financial value, we start to get ourselves into trouble. So from a financial perspective, what is value mathematically? I've described it in words. Well, mathematically, it's a discounted cash flow model. Okay. Now, what that means in words is value by definition is future cash, not past cash, not today's cash, future cash that you can put in your pocket, discounted for time and discounted for risk. Okay. Future cash in your pocket, discounted for time to today, discounted for risk to today. That's what value is. And absolutely purely speaking, that is a discounted cash flow model. A discounted cash flow model, for those of you that don't know, are not finance wonks, is basically just picture in your head a spreadsheet. You know, year 1, year 2, year 3, year 4 just goes out for as long as you want. And it calculates cash in, cash out, net cash at the end of each period. That's your future cash. Then you discount it for risk and discount it for time, and you end up with a value as at today. Okay, that's what a discounted cash flow is. And all value, by definition, is discounted cash flow value. Any other methodology to calculate value is a cheat. It's a shortcut to a discounted cash flow model. It's because you can't do a discounted cash flow model easily in your head. You can do a multiple of revenue easily in your head, but you can't do a discounted cash flow easily in your head. It's because when you start doing a discounted cash flow model and you sit down and you're typing numbers in a spreadsheet, you're like, I don't know if these are right. What if it was this other than that? And you start getting into information lack of information problems to do what you consider to be a more or less accurate spreadsheet, a discounted cash flow model. And so you revert to multiples. Also, when you're trying to get comparable information as a valuator, you do it on a multiple basis. You don't do it on a discount rate basis very often. You can, but you don't normally. And so that also causes a problem. So, for example, but I think the important thing to understand is value, purely speaking, is a discounted cash flow. That's what it is. And if you are doing, for example, let's use $1 million EBITDA company, $10 million EBITDA company with an 8 times multiple is $80 million, assuming there's no debt. So you have a value of $80 million. 10 times 8 is 80 million. What is in that 8 times multiple? Well, there's a few things. One is there's assumption that there will be maintainable base EBITDA of the $10 million per year forever into infinity. That's a key assumption in that 8 times multiple. There's another assumption. The other assumption is that not only will there be $10 million of maintainable earnings, but there will be a growth rate on top of that. And with a 10 times multiple, depending on the interest, that growth rate, the industry, that growth rate could be in the range of, 5, 6, 7, 8% per year. Okay. So there's, just call it 6, just for round numbers. And so 10 million as a base EBITDA per year into infinity, but annual growth to that 10 million of 6% per year, every year to infinity is an also implied assumption in that 8 times multiple. Okay. And the other assumption in that multiple is risk. You've assumed a stable amount of risk. A stable amount of risk, like a discount rate, except the inverse of that, a stable amount of risk in that multiple, and that it never changes again into infinity. Those are 3 implied assumptions in that 8 times multiple. So all you're doing is taking a shortcut to a discounted cash flow. Probably a long and wonky way to explain that to you. And so, but that's what it is. It's important to understand what value is in a financial sense, okay, which is different entirely from societal value. So let's say you have a company that is highly risky and is going to pay you nothing as an investor for 20 years. And in 20 years, this company will be worth and saleable for $1 trillion 20 years from now, okay? So you're doing something huge. Forget Mars. We're going to Venus. We're going a long way away. We're going to colonize that. We're going to change this society, and it'll be worth $1 trillion 20 years from now. But we have to spend a lot of money to get there. Now, if you do a cash flow with a high degree of risk like that, and you're going to, let me start again. If you're in a different way, if you're doing a discounted cash flow as an analyst, one of the things you quickly learn is that, past 3, 4, 5 years out, it really doesn't matter what the cash flow is at that point. The entire thing is driven by the short-term cash flow because discounting has a massive impact on the value. So to give you an example of that, if you were to calculate the net present value of $1 trillion 20 years from now, in my example, and you were to discount that at, say, 50%, which is not an unreasonable number. It sounds like a lot when you say it, but back in my day, the venture capital discount rates were around 40%, and that was a less risky proposition than this hypothetical situation that I'm outlining for you or for us. And so let's just use 50%. Well, the NPV of that, net present value of that trillion dollars, discounted at 50% for 20 years to today, is somewhere north of $300 million. Okay, so let's call it $350 million. I have the number exact somewhere, but not in front of me. Okay, so it's less than $400 million from $1 trillion. Now, 400 million sounds like a lot, or 350 million sounds like a lot, but it's a lot less than $1 trillion, all right? And that $350 million is what they would consider in the investment world post-money. In other words, if you could actually do the things that you need to do, and you had the money that you need to do the things that you need to do to get the $1 trillion, it would be worth the $350 million. Okay. but how much money do you need to invest to make this thing work? Because if you need to invest $30 million, $300 million, then the pre-money valuation would be the 350 minus the 300 is a $50 million pre-money valuation. And so it's the net present value, the time and the risk really kicks the crap out of these projects that have a huge payoff, but way, way down the road. Now, I'm going to tell you why I shot this show twice. And I'm going to tell you I shot this show twice because, when I'm preparing for shows, I don't know what other podcasters do, but I give myself 45 minutes to an hour to shoot a show. I give myself a half hour to 45 minutes to, do the quick editing, put a thumbnail on it, upload it to YouTube, write some comments. So, now I'm into an hour 45 out of my day once a week to do that. And I give myself maybe half an hour to prep for the show, just write myself some bullet points. Here's what I'm going to do. And so I knew what I wanted to do. And I said, I knew I wanted to create this hypothetical example. And so I popped into ChatGPT, the artificial intelligence that is all the rave. And I asked the robot, I said, hey, what is the net present value of $1 trillion 20 years from now, discounted at 50%? And ChatGPT came back and it said, well, here's the formula. NPV equals the fair value divided by 1 plus R to the power of N, which is all true. Okay, I won't bore you with what that is. And then it goes through the math for you. Okay, and what it says is that means it's it's equal to 1 trillion divided by 1 plus 0.5, so 1.5 to the power of 20, because it's 20 years. And then it calculates the 1.5 to the power of 20, and it does the NPV for you, and it comes out with $953.67. Why? Didn't come up with 350 million. Came up with $953, this artificial intelligence. And why, if I go back and analyze it, which I did later, is because it's just is dead wrong on 1.5 to the power of 20. It just had that dead wrong. And because I don't prepare in so much detail, and maybe I'm a little bit like Anchorman, I just read that in the first version of this. I just read that out and I just went with it, even though it's just completely ridiculous. And as I'm uploading it to YouTube after I did all the editing, thank God it's on a time delay, I uploaded it and I said, what? That can't be right. So then I freaked out and I texted my investment banking analyst associate, and he came back with the right numbers. Yeah, that makes way more sense. What the hell am I doing? And so beware of ChatGPT doing your math for you, because it's sketchy. It's sketchy. I did as an aside, complete aside, I did a science project with my daughter, and I wanted to get some ideas just to get the thing rolling. I didn't tell her, but I wanted to do it for myself. So I type in the project, her grade, this is what, this is the topic, here's what we're trying to do. Spits out the whole thing. It was amazing. Then I asked for references, spits out references with links. Every one of those links was fabricated. They didn't exist. They're not real links. It just literally made them up as it did the math. Beware of that artificial intelligence. All right, so my first point here on the why don't fund people or financial investors invest for the really long term in life-changing, species-changing deals, it's because if you don't have more immediate returns, then it just drives the value down, and value is monetary. It's math. Okay, so that's my point number one. My point number two is, let's say you're a fund manager. Okay, you're a venture capital fund, you're a private equity fund, you're some other kind of fund. By definition, you have raised money into your fund. You've gone to some other people, whether that be public markets, institutions, sovereign wealth funds, whatever, and they have given you money. And to get that money, right, VCs, venture capitalists don't invest their own money. For the most part, I'm not saying some venture capitalists don't have principal investments, but for the most part, they're managing the money of somebody else. And to get that money, they prepared a deck and they went to a meeting and they signed contracts. And in that deck and in those meetings, they said, hey, here's what we're about. We're going to invest in these types of companies, software, whatever, green energy, whatever it might be. We're going to invest in these sorts of companies. We're going to target a portfolio return of whatever, let's say 15 to 20%. Just made that number up. Don't hold it to me, but to give you an example. So we know that 8 of these things are going to crap out, but the other 2 out of 10, the other 20% are going to generate a return sufficient that you, Mr. Investor, can get back this 50 to 20% on your money. And most importantly, it describes an exit that we're going to have this fund and it's going to last 10 years, sometimes 7 years for a PE deal, whatever the number is, but it's not indeterminate. Like it's not forever. It's a limited amount of time. We're going to have this fund. We're going to wind it up in 10 years and we will pay you your money back with the accrued gains, right? Well, if you have a 10-year fund, how do you do a 20-year deal? Doesn't work. You're limited. So the idea of a fund, which is where most of the money is, investing into these longer deep tech projects, it doesn't work from a value perspective when you work through the math, and it doesn't work from a structure portfolio perspective. And I'll tell you a pro tip, as it were, about raising money and dealing with financial institutions. Yeah, your deal is important. Yeah, the management team is important. But just as important, and you never think about this, is portfolio management within the institution, and you have no visibility on that whatsoever. It's a big deal. It's completely underestimated all the time. And that is a reason, one of the reasons, the structure of the funds themselves, that they're unable to invest in these sorts of deals. So how might a company who has this sort of idea, I want to go colonize Venus or whatever, how might you go about financing it? Well, does that mean you can't do it at all? No, it doesn't mean that. Here's a couple of things that you could consider to get these deals done. Remember, you can't change the math, but here's what you could do. Number one is you could create assets in the short term, okay? You don't just go from nothing to going to colonize Venus 20 years from now and being worth $1 trillion, okay? There are steps along the way, and those steps are probably intellectual property, patents, new technologies, whatever that may be. And patents and new technologies and intellectual property have value because there's a market. You can sell patents, you can sell intellectual property. They have other applications, and you might be able to create some decent IP in the first couple of years of that deal, which means you've created value in the short term. Didn't get the $1 trillion yet, but you've created assets and you have therefore created value. So that should be incorporated into your business plan. And if you are investing in these sorts of deals, you ought to look for these regular interim asset creation parts of those business plan so that you have some value to fall back on. And when you have value to fall back on, it changes the risk profile for you. You can also talk about, consider shorter term business. So not just sitting around having no business until you've got the $1 trillion 20 years from now, but doing things in the interim that generate revenue and cash flows and therefore create value. I asked the robot again, ChatGPT, about SpaceX, which was one of the questions that was referenced to me. And I think this is accurate, but who the hell knows after I got the math error. But it says that SpaceX was founded in 2002. And here are some of the business activities SpaceX has undertaken so far. And remember, their main mission is to get to Mars. Okay? But they have businesses in launch services. SpaceX offers launch services for commercial and government customers using its reusable rockets and spacecraft to deliver payloads into orbit. That is a business. They get paid for it, and it generates cash. I've never looked at the financial statements of SpaceX. I don't know if they're profitable, not profitable. I don't know that. But the point I'm trying to make is you can create businesses along the way. 2, Dragon spacecraft. They developed a spacecraft, a versatile vehicle capable of carrying cargo and crew to the International Space Station. Again, a business in the interim before getting to Mars that generates money. A huge one, Starlink. They build satellite internet constellations called Starlink. They basically, at this point, blanket the whole Earth. I understand that, and they can provide internet services to not so much in the urban areas, but in the rural areas. It's just a far better solution basically for the whole planet. Okay. And that is a byproduct, in a sense, of the technologies that they were building for their main mission. So there's an example of a company that's got a way off in the distance, life changing thing, but also created businesses that are life changing along the way and have more immediate value that can be valued and can be what's the word I'm looking for? You can do the math on it. That's what I'm trying to say. So again, I've never researched SpaceX. I'm not an investor. I don't know a ton about it, but I'm willing to bet if you were looking at valuing a SpaceX, it would be more on these operating businesses like Starlink, for example, than it would be on the master plan, on the vision. Okay, so if you're trying to finance your dream, your your societal changing business, think about creating assets and think about creating businesses along the way. Obviously, it helps if you have your own deep pockets to fund this thing, but if you don't, let's circle this back to the beginning of this podcast: strategic investors. Again, people invest in dreams, companies invest in dreams, and they also invest in new strategic, possible roll the dice type technologies for their own reasons, which may not be financial, right? So think back 7, 10 years ago to the oil companies. What was the big trend? Don't hold me to the 7, 10 years. Someone will correct me on that, but it feels like 7, 10 years ago. The trend was they were all jumping into green technologies with serious dollar investments into these spaces. Now, 7, 10 years ago, green technologies were very much unproven. Maybe still today, they're very much unproven, but we don't need to worry about that. We can all agree for sure that 7, 10 longer years ago, very much unproven. Why were the oil companies diving into this? Was it for the financial math of the situation? Or was it the strategic benefit of getting the regulators off your back, the branding and the marketing that goes along with, being good people in the universe, right? And combating the negativity that was associated with their core business. All right. So create assets, create businesses along the way that generate cash flow and that can be valued. Look for strategic investors. And there's some ways to try to finance that society changing dream. All right. So there's some thoughts for me. I hope that was of value. This is my second time doing this show. As I said, do not trust that chat GPT as much as you think you could. Thank you, everybody, for listening. This has been the Winning Momentum podcast. Check it out on all my content on thescottsinclair.com. You can listen to this show on YouTube, Apple, Spotify, podcasts, everywhere that you listen to audio podcasts. Have a great day, and we will see you next week.